Hello and welcome to Earnings Echo. We put together the most important information about Samsara. Let's skip the pleasantries and jump straight into the Q1 FY27 hard facts. I want to know if the reality of this quarter actually matches the massive hype around their platform.
Well, the data is incredibly strong. Revenue just hit $478.8 million, so we are looking at a 31% year-over-year increase.
Right. And what are the recurring revenues?
So ending ARR reached $1.991 billion, and their GAAP EPS came in at 8 cents. Plus, management felt confident enough to raise FY27 revenue guidance up to that 2.005 to 2.013 billion range.
Oh, I need to critically push back on that 8-cent EPS beat, though, because doesn't that 8 cents include a very specific $30 million arbitration award from their lawsuit against Motive?
It absolutely does. That lawsuit gave them a clear one-time cash injection. But if you pull that $30 million out entirely, Samsara still would have remained GAAP profitable.
Okay, so they hit foundational profitability regardless of the legal win. But looking at the operational catalyst behind that 31% revenue surge, I have to ask about the margins. Why did their GAAP gross margin drop 200 basis points down to 75%?
Well, top-line growth is really coasting on large customer momentum. They now have 3,363 customers spending over $100,000 in ARR. And emerging products are driving over 20% of their net new ACV.
Like that massive software-only connected asset maintenance deal with Hertz, right?
Exactly. But to power those specific AI predictive maintenance tools, they had to heavily invest in cloud infrastructure. So that gross margin compression you mentioned, that is a direct result of aggressive AI investments.
Got it. But they managed to offset that spend elsewhere.
Yeah, they were incredibly efficient with their G&A. That corporate discipline actually drove non-GAAP operating margins up 5 full points to 19%.
So they're essentially funding this AI land grab with tight corporate execution. Let's pivot to the earnings call sentiment and valuation then. For you listening, we like to look at the reverse DCF model. It isn't an exact science, obviously, but it is a critical tool to reveal what growth the market is currently pricing into the stock.
Right. And running the numbers at $34.09 a share, you have an enterprise value of $18.5 billion. Our data shows the market is pricing in a 17% free cash flow KGR over the next 10 years.
I mean, 17% almost feels conservative against their current 31% revenue growth and a $117 billion TAM. But trading at 79 times TTM adjusted free cash flow is undeniably steep.
It is an incredibly steep premium. Management was highly confident on the call, though. They pointed out their top 100 public customers are up 30%.
Sure, but if you run a traditional forward-looking DCF model, it lands closer to a $14.5 billion valuation. That implies roughly a 26% downside risk from where it sits today.
Yeah, the physical world is notoriously unpredictable. And with that 79x multiple, they have absolutely zero room for execution missteps.
To summarize the long-term investment echo for you today, Samsara is successfully capturing this bits to Atom's physical AI transition amidst a massive global infrastructure build-out. But like we just discussed, the premium valuation leaves no room for error.
Exactly. The question is whether their expanding AI moat can ultimately outrun the gravity of that multiple.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.